Hello people, how are you all? Hope you are doing good. I'm good as always. Let's just start. Wait a minute. Where did I say this? Actually, I'm trying to upload the video, okay? Since it is taking so much time, 35% uploaded. I started uploading at around 2:10 or so. So also, you do not have to watch the earlier video. You just have to watch this if you want to. Okay, but I'm not going to remove that earlier video for me. Also, also nothing much to say. There is a bit stuttering in this video also, but it is manageable. I really hope it won't happen again and again. I'll try my best. So let's. Actually, I'm thinking to not solve true or false and MCQs for now. I just want to solve after the entire unit one. If it is okay for you, I mean, we don't actually communicate, I know that, but I think so. I think that would be the right way for me so that you get to revise again and again. Okay. And then let's start with chapter 2. How do I download chapter 2? Actually, chapter 2, I'm taken from Saransh, ICAI Saransh book. Okay. Just to go to ICAI BOS. Actually, net is slow, I think. In just ICAI BOS, you get to download Saransh video. Since net is kind of a bit slow, let's just jump into the chapters. I'm thinking of covering from chapter 2 to chapter 7 so that instead of going deeper, I just want to cover briefly and want you to revise. Okay. This is chapter 2. If there are any missing topics, I will also check in ICL material. I'll just add them. After chapter 2 till chapter 7, after that, we will do the MCQs and then go to chapter 2, unit 2, or whatever. I just get confused. Accounting concepts. This is basically chapter 2. Okay. Accounting concepts, principles, and conventions. Wait a minute. Accounting concepts define the assumptions on the basis of which financial statements of business entity are prepared. What is the accounting concept? The accounting concept means it define the assumptions. Accounting concepts define assumptions. Why do you assume? Because as I told you in the previous classes, management assumes certain things while preparing financial statements. What are financial statements? Profit and loss account, balance sheet, statement of changes in equity, etc. Cash flow statement and note statements. In order to prepare financial statements, what and why the need of assumptions? If you have this question, you will find the answer in chapter in audit subject in CA Inter. Accounting principles. This is kind of technical. Let's skip this for now. Accounting concepts. There are many accounting concepts here. We'll talk about one by one. Okay. Entity concept. First one. This is very important for MCQ point of view. They definitely are. There is a high chance of them asking 2 to 4 marks from here, or at least 2 marks from entity concept. Business enterprise is a separate identity. apart from its owner. If you remember in the separate legal entity in Companies Act, okay, if you remember in your intermediate, they always keep on telling you that business owner and the company both are different. They are not the same. This is the entity concept. Business enterprise is a separate identity apart from its owner. All the business transactions are recorded in the business books of accounts in keeping business affairs free from influence of personal affairs of owner. Business transactions are recorded in business books of accounts. Okay. Business enterprise is separate from the person who owns the business. Okay. Money measurement concept. Only those transactions which can be measured in terms of money are recorded. We already discussed like this. If you measure in terms of money, those are the transactions that only can be recorded. Transactions, even if they affect the results of business materially, if if there are certain transactions that might affect the business materially but are not valued in monetary terms. If there are business transactions that might impact businesses very huge material but might not be in monetary in nature, those are not recorded, which is money measurement concept. Entity concept, money measurement concept are the periodicity concept. This is also called as concept of definite accounting period. As per going concern concept, an indefinite life of an entity is assumed. Going concern, we'll talk about this point later. For a business entity, it causes inconvenience to measure performance achieved by the entity in the ordinary course of business. For example, I will tell you going concern right now. Going concern concept tells you that, like, why do you, if I ask you a question, if when you're starting business and if I ask you a question, when will you close the business? Will you be able to answer me? Actually, no. So there is a presumption that uh, the presumption is called going concern. There is a presumption that businesses carry for a foreseeable future. What is foreseeable future? A rough estimate. Like if you ask me when I'm doing a business, you tell me, you ask me whether how long will I continue in this business? I say like around 15 years, 20 maybe. It's fine. That's the foreseeable future. So periodic, that is going concern concept. Periodicity concept tells us that if you are measuring, if you think you are going to continue business for a going concern period for a 5 years, 10 years, but how can you assess that whether business is profitable or not? Which is the exact reason periodicity concept came into existence. So it divides the entire going concern period into years. For example, sorry for my straight line. This is entire, this total first and last point is going concern period, okay, which is a foreseeable future. We cannot say from day one that we are going to do business for 8 years, 10 years, etc. because it depends on various circumstances. But this is the periodicity period, okay, so that we can have equal measurement. This periodicity period is of 1 year from which 1 year? Accounting 1 year, okay. According to this concept, accounts should be prepared after every period and not at the end of life of the entity. Usually, this period is of 1 year. Hence, periodicity concept facilitates in comparing financial statements of different periods. Okay, uniform, consistent, and consistent accounting treatment for ascertaining profits and assets of business. Consistent accounting treatment. Okay, matching periodic revenues with expenses. Matching concept. This relates to this. All expenses matched with the revenue of that period should only be taken into consideration. I'll tell you. In the financial statements of organization, if any revenue is recognized, then expenses related to earn that revenue should also be recognized by an entity. The concept is based on accrual concept, as it considers occurrence of expenses and income and do not concentrate on actual flow of cash. I hope you know accrual concept. Okay, there is something to discuss here. Wait, let me check the time span. 10.5 minutes is fine. For example, for a period, for example, all expenses matched with the revenue of that period should only be taken into consideration. For example, if you are buying something, example, how can I say? If you are buying something to sell something, you can set up that thing. For say, how can I put that in word? Let's again read this. All expenses matched with the revenue of that period. For example, you paid 10,000 to sell something for 15,000. That 10,000 can be recognized in that financial year. If you pay 10,000 for selling 15,000 for the next year, you cannot recognize this 10,000 in this current year because of the matching concept. Whenever you are spending something, how can I say? Let me read this. All expenses matched with the revenue of that period, which is that financial year, should only be taken into consideration. Should only be taken into consideration means should only be recognized in profit and loss. In financial statements of the organization, if any revenue is recognized, then expense related to earn that revenue should also be recognized by an entity. For example, if any revenue, in order to sell 15,000, you had to pay 10,000. So if you are recognizing that 15,000, you should also recognize the 10,000. 10,000 expense, 15,000 income. This concept is based on an accrual concept as it considers occurrence of expenses. Accrual concept says you whenever you earn an income or incur expense, then you recognize in the books of accounts. It does not consider receiving or paying actual pay cash transactions. Cost concept. The value of an asset is to be determined on the basis of historical cost. Historical cost means acquisition cost, like how much did you pay to purchase an asset, transportation expense, any other taxes. Although there are various measurement bases like uh, fair value basis, market value basis, etc., accountants traditionally prefer this concept in the interest of objectivity. So, since there is objectivity here, you cannot, how can I say, for market value or fair value, especially for the fair value. What is fair value? We will talk about fair value later. For fair value, there is subject to interpretations. What is subject to interpretations? Like subject to decision making should is there. But for acquisition cost, there is no subject to decision making is there. For example, if you buy a pen from me or from Michael Jackson, the the amount of pen is the same. The cost you pay is the same. Doesn't matter whether it's me or Michael Jackson. Uh, I don't know if I am Michael Jackson. Realization concept. It closely follows the cost concept. Okay. Any change in value of an asset is to be recorded only when the business realizes this. Any change in the value of an asset is to be recorded only when the business realizes it. I hope you understood. If accountants anticipate decrease in value, but if there is increase in value, then ignore it until it is realized. We'll talk about this later. Or if you try to understand, you can get this. If accountants project that decrease in the value of an asset, but if there is I thought the asset value could be decreased, but it actually increased. Then the increase in the value shall be ignored until it is realized. Dual concept. This concept is the core for double entry. I keep on talking about dual concept because this is the logic of you balancing the balance sheet, and you are going to love this when I explain when we solve big problems. Every transaction or event has, let's cut this off because just talk about transaction. This is not wrong actually for our simplicity. There are two aspects: increase in the asset and decrease in other asset. One increase in asset or one decrease in another asset. Increase in asset, increase in liability. Okay, let me, can I write this? Asset increase. Just close your eyes and imagine if you have ever seen a balance sheet. Just imagine if there is an increase in the value of asset, how can the balance sheet shall be matched? Imagine if asset value is increased. Okay, asset value increased by 10 rupees. So assets will get 10 rupees more than liabilities. How can the balance sheet shall be balanced? The possibility is one, the value of other assets shall be decreased by 10 rupees. That is what they said. Second, if the asset value is increased, the liability value of 10 rupees will be increased. That is what they said. Third, this is vice versa. If there is a 10 rupee decrease of the asset value, then the liability side will be higher of 10 rupees. Then there are two possibilities. Maybe the asset value shall be decreased by 10, increased by 10 rupees to balance, or uh, let's say this is asset, this is liability. Asset value is decreased by 10 rupees. There are two possibilities. Either increase the asset by 10 rupees, or if it is here, decrease the liability by 10 rupees. That is what they said. Just don't get confused. This is so easy. Okay. Just close your eyes. Just keep your hands like this. Okay. Which is why I'm Michael Jackson fan. He teaches us accounting so much. He taught us. Sorry, he's in past. He was in past? No, he is in past. Yes, that's the correct wording. So just close your eyes and keep this like this. This is asset, this is liability. Okay, this is balance sheet. Whenever you are making any entry, just check whether asset value is increasing. So as I told you, there are double entry. This is double entry concept. In order to balance, either decrease first, there is you recorded asset values increased. Okay, that's one thing is done. Just imagine how should be the other kind of other side of adjustment. Maybe decrease in asset value or increase in liability and vice versa. This is exactly opposite of that logic. Just keep this in mind. Okay, do not you don't have to read this because you get confused. Just they are reversing it. Just reverse the liability. Like close your eyes, liability, decrease in liability. What should I do? Either increase the liability or decrease in the asset. That's what they said. Decrease in liability, increase in liability. This is what I talked about. Conservatism. This dual, this is what we are going to apply practically. Okay. That is what I'm going to teach you, which is why I'm very confident that you are going to love the batch. Wait a minute, I'll check. 37% is here, 19 minutes are okay. CPU's 46% for okay. Principle of conservatism. Conservatism. What do you mean by conservatism? It is conservatism is negative. We don't like conservative people, okay? This is very negative. We are so much positive people. Okay. Conservatism states that accountants should not anticipate any future income. For example, for example, I just went to a meeting. I have my income is around 10 lakhs. If the other person whom I went to meeting accepts my project, example, my revenue jumps to from 10 lakhs to 15 lakhs. So can I recognize 15 lakhs in this year? No. That is what that is one side of the issue. Future anticipated income shall not be recorded. But you ask me, sir, just okay, income is not going to be recorded, future projected or anticipated. How come it is negative? You just said negative. Okay, I will tell you. However, this is where story begins. They should provide for all possible losses. This is a twist. Okay. Future projected revenue shall not be recognized. Future anticipated, not projected, anticipated losses shall be recognized. For this concept, there should be at least three quantitative characteristics of financial statements, namely, in order to recognize, there should be three things. This is kind of important, okay? Faithful representation of alternative values, self-explanatory. Whatever I am unable to explain, it is still self-explanatory. Faithful representation. Faithful representation you get in CA for CA inter audit, okay? It just says that represent the values are genuinely and correctly represented faithfully of all alternative values, all possible values also. Okay. Prudence. Prudence means judgment about the possible future losses which are to be guarded, as well as gains which are uncertain. Okay. Judgment. Prudence is a judgment about all possible future losses which are to be guarded. Gains are uncertain. Neutrality or unbiased outlook is required to identify and record such as possible losses as well as to exclude uncertain gains. Okay. Again, I am going to tell you faithful representation of alternative values in conservatism. Second thing, prudence, that is judgment about all possible losses which are to be guarded as well as gains which are uncertain. Prudence concept tells you about judgment. Why do we consider all this? Because whether to recognize the possible losses in current year or not, current year profit and loss or not. There are three things. For example, you come to me and ask me, sir, should I record future legal litigation? I don't know whether we have chances of gaining the case. If we lose, we have to pay the penalty of around 50,000. I tell you, okay, bro, just consider three things. You don't know you don't know whether you consider, no, right? So I tell you three things. Okay, just imagine, just to check whether there is a faithful representation of alternative values. Okay, second, follow the prudence concept. You ask me, what is prudence concept? Just to judge. You are the judge. I mean, you are the management, so you judge about for all possible future losses which are to be guarded as well as gains which are uncertain. And then neutrality. Okay, it is self-explanatory. Materiality, it comes in CA final auditor. According to materiality, all items having significant economic effect on the business of the enterprise should be disclosed in the financial statements. Significant economic effect. What is, wait 1 minute. What is significant economic effect? Economic effect of the business. Okay, they gave it. Significant means more. Economic means financial, monetary. Business effect means effect of the business. Enterprise should be disclosed. Any insignificant item which will only increase the work of the accountant but will not be relevant. Basically, they are saying insignificant items shall not be considered. Significant items shall be considered. Fa- Fundamental accounting assumptions. Let's use this. Okay, just one page in chapter number 2 is done. Unit number 2 is going to be completed. Going concern consistency, GAC GAC. Going concern. Going concern means I just explained it. Financial statements are prepared on the assumption that an enterprise is a going concern and will continue to operate to do business in a foreseeable future. A accrual. The effects of transactions and other events are recognized on mercantile basis. What is mercantile basis? Not on cash basis. What is cash basis? If you pay cash and if you receive cash, I record profits. No, that's not how accounting works. If you pay cash, if you pay expense or incur expense, we consider incurring also. When they occur, they are recorded in the accounting records and reported in the financial statements of period in which they are related. Okay. This is kind of irrelevant if you want to read. Okay, you can. Consistency. All accounting policies are followed consistently from one period to another period, and changes in accounting policies to be made only under exceptional circumstances. Accounting policies. What is accounting policy? I'll talk about this later. Okay. But when you are following a certain accounting policy, I can explain, but it is kind of lengthy. Okay. For example, there are fixed assets in the balance sheet, right? Like building, furniture, plant property, equipment. Okay. A fixed asset as per accounting standard 10 or Indian accounting standard 16. These are the standards. We'll talk about standards later. These things tell you the value of assets shall be recognized. Fixed assets shall be recognized or measured based on cost or fair value. You can change this also. You can remeasure. Change means remeasure. For example, for 1 year I consider cash, and for another I consider a fair value measurement. This is what they are saying. Okay. This is one accounting policy. Accounting policy shall be consistent across the years. Okay. It shall be consistent. You cannot be like, you can change, but you shouldn't change. Okay. You understand? You have every right to change from cost to fair value method in fixed assets, but you should not change depending upon your will because it affects the profit. Last topic, qualitative characteristics of financial statements. Completeness, if there is correctness, comparability. Financial statements shall be complete. Financial statements shall be comparable with other periods. Understandability, it should be understandable. Prudence, we have already read this. Substance over form. Substance over form means legality shall be overridden. If there is, how can I say, legality can be overlooked for certain things. Okay, that is substance over form. Form is legal nature. Substance means whatever we are doing. There are certain things like GAR provisions in Income Tax Act 1961. Even I don't know if there are GAR provisions in 2025. They are exact example of substance over form, because there can be some possible loopholes we can catch based on law. Substance over form tells you what is your intention behind the usage of that loophole. Obviously, if you pick loophole, you're going to abuse the law. So substance over form immunes the law to get abused. Materiality, we talked about it. Relevance, reliability. These are terminologies you should be comfortable with, because this is going to be an audit. Faithful representation, neutrality, full and fair, adequate disclosures. Disclosure should be made. What is disclosure? Whatever you are showing in balance sheet, financial, whatever you are showing in financial statements is a disclosure. Okay. Again, I'm telling you, completeness, comparability, comparability to understandability, understandability to prudence, we have already talked about. Substance over form, which is new for you. Materiality, which we talked about it. And RR, reliance and reliability, faithful representation, and full fair disclosure. We are done with chapter 2. Let me end this video here. Let me end this video here so that I don't know whether this stutters. So, okay, bye. Please, I forgot. Please like, share, and subscribe. I know these classes are boring and I'm not even properly explaining. I know that. But just when we jump into practical part, you're going to be amazed. Just trust me on this. Just have blind faith in me. For the time being, just for these couple of videos, even if you don't watch, it's fine. But watch those practical videos. Okay. Thank you so much.